you know the government's quietly passed a new ring fencing bill into law. We only just caught up with this, but slow. Fortunately, our friends from Property Apprentice, they knew. Debbie Roberts is with us and she can explain all these changes. If anyone knows Property Apprentice, they will know. So tell me this. What is it again? What is ring fencing?
So ring fencing, now the reason it slipped under the radar is because it was named something really obscure. So the name of the bill is actually Taxation at Annual Rates for 2019 to 20, GST Offshore Supplier Registration and Remedial Matters
Trickery.
Bill.
It's trickery.
It's a little bit obscure.
They've mugged us. They've mugged us.
A little bit. So, yeah, it was actually past its third reading last Thursday. And then, yeah, so...
Oh, it looks like a technical sort of regulatory bill about something.
It does.
And it's about ring fencing, which means what?
So ring fencing basically means that instead of being able to get a tax refund from the government or from Inland Revenue at the end of the tax year, if your rental properties run at a loss, instead of getting a tax refund, those losses are going to get carried forward. So my accountant says that I'm not allowed to call them tax credits, but they kind of are.
Of course they are. They get
So it
carried
just
forward to
delays
where? To next year?
To the next financial year. And they'll keep getting carried forward until that rental property starts to make a profit. So basically what it means is there's absolutely no changes to the tax benefits. It's just a timing issue.
Well, it means you don't get a refund.
You don't get the refund, you just don't have to pay tax on the profit that you make when you start making a profit.
So people will be out of pocket?
Yes, so it'll affect people who own rental properties that run at a loss if they own them in their personal names or if they own them in look-through companies. Anyone who owns a rental property in a trust, there's no change to them because they've always had those losses carried forward anyway.
But it's a bit sneaky putting it through this way, isn't it?
Well, potentially it is a little bit, and I think it's going to affect a lot of mum and dad investors, especially the ones that have been, sucked in by those companies that promote negative gearing as a great investment strategy.
Of them did. Does it mean, therefore, that landlords will try and recoup some money, so they might try and push the rents up, and it might have a very perverse effect that Labor hadn't thought about? Yeah,
so I think potentially it will, because there will be some mum and dad investors who've been relying on that tax refund each year to help cover the cost of owning those properties. So if they can't afford to top them up out of their own back pocket, then it potentially means that they're not going to be able to afford to do the repairs and maintenance that might need to be done. They'll delay those a bit further. Some people might have to sell. I think certainly landlords who are in that position are going to look for every opportunity to increase rents when they can.
Why do this? I mean, why?
Yeah, I mean, I think potentially one of the good things about it is that maybe the general public will stop thinking that property investors are using investment as a tax dodge, because it's not a tax dodge.
Is it something like only accountants, it sounds like, are going to be lining their pockets on this one? Because it certainly doesn't sound like any of the homeowners or property investors are.
So property investors who've balanced their portfolio for capital growth and cash flow won't be affected at all. So this is what we teach. They won't be affected at all, because we always crunch our numbers on pre-tax cash flow, because tax benefits can change, so, and same with capital growth. You can't control capital growth. So all of those things that you can't control, we minimise.
Can't control the government?
Can't control the government, can't control tax changes.
Well, I think the reason why they're pushing this through quietly is they did make an initial song and dance. They were going to do this in the interest of equality and all that. And they saw what happened with their thoughts on tax, particularly the capital gains tax, and now they're just trying to do this on the quiet, because when people really delve deeply in this, they'll see that it's a foolish thing to do. But you talk about negative gearing. You obviously don't like it. You don't think it's a good strategy.
No. Do you want to know why I don't think it's a good strategy?
But surely if you buy in high capital growth areas where you're in it for the long term and you can afford to negative gear, it's not that bad a strategy.
Unless something happens to your income, and then you're in trouble. Because if you're having to top something up out of your own back pocket and then something happens to your income,
you're in trouble.
How do you top those things up?
You're forced to sell.
So one of the potential issues that could arise from this, I think, is that a lot of new builds actually don't cover their costs when you first purchase them as rentals. So if you're buying a new build, under the previous rule, you could get those tax refunds to help cover that cost. Now those are going to get carried forward.
This might actually stop, another perverse effect might stop the new builds being built, which is not what we want.
Exactly.
Better move on.
Thank you.
Debbie Roberts, Property Apprentice.